Welcome to GRE. I'm your host, Keith Reinhold. There are some dire warning signs for the future of our economy. We're joined by none other than the father of Reaganomics to break it down with us today as late President Ronald Reagan's budget director joins us. When is this perpetually postponed recession coming? Why inflation and high interest rates could carry on for the rest of the decade, and what it all means to your finances and real estate today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Reinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Glen Burnie, Maryland to Glen County, California, and across 188 nations worldwide. I'm Keith Reinhold, and you're listening to Get Rich Education. We're going bigger picture this week. Before we talk to President Reagan's money guy in the White House, understand that today's guest was also one of the founding partners of Blackstone, and they are in the real estate business. So you're going to get a lot of deep, uniquely qualified insights today. And I'll tell you, what's going on around here lately? Things have been feeling awfully presidential between last week's program and now this week's program. Hey, stars and stripes forever. Semper Fi. Hoorah. Now, as the greatest detonation in the history of the world, how in the heck are we, as the United States, going to keep financing our debt? Now, you can think of a treasury, also known as a bond, as an IOU. As we take on debt to fund our government spending programs, really what we do is issue then these IOUs to the rest of the world, and then down the road, we need to pay back these IOU holders, treasuries holders, whatever we've borrowed, with interest on top of that. That's a really simple way to describe how it works. Think of a treasury as an IOU. Well, we have $9 trillion in treasuries that need to be rolled over at higher interest rates just this year alone. Okay, well, how does the market look for that sort of thing? Well, a lot like before you decide to sell a piece of real estate, you would want to know how that buyer's market looks. How's the buyer's market for us selling more treasuries, which is basically us issuing more IOUs? How is that world interest level in our treasuries? Well, this is a time when the world is selling treasuries. We're trying to get rid of them. Well, why would they buy more when we keep printing like crazy, debasing the dollars that they'll eventually get their treasuries repaid in down the road? Case in point, China is down to just over 700 billion of treasuries that they're holding. Well, they were at 3 trillion not too long ago, more than 4 times that. Russia and Iran sold all of their treasuries. Other countries are shedding them too, like Japan. It gets even worse than that, because the number one holder of our own debt is our own Fed. And then it gets even worse than that yet, because even our own Fed is rolling treasuries off of their balance sheet. So who is going to finance this often irresponsible U.S. spending, the $10 trillion or $11 trillion every single year for the next 10 years that we have obligations toward already? And it looks like all those are going to be at higher interest rates too. Now, I am not telling you how to think about us as the United States, for example, sending foreign aid to multiple nations. That's up to you to decide, whether it's Ukraine or the Middle East or Taiwan. That gets political, and that is beyond the scope of GRE. We are an investing show. What I'm saying is that backdrop that I just gave you, that's something that you need to take into consideration as you weigh those foreign aid decision types. Speaking of getting worse, do we at least have competent decision makers today? Now, as we'll talk to the father of Reaganomics here shortly, someone that served in an earlier era, here's a clip from this era that really went viral lately, but it's apropos to play it here. This is Jared Bernstein. Today, he chairs President Joe Biden's Council of Economic Advisors. How much confidence does this instill? And remember, this guy chairs the economic advisors to today's president.
The U.S. government can't go bankrupt because we can print our own money.
Like you said, they print the dollar. So why does the government even borrow?
Well, again, some of this stuff gets, some of the language that some of the language and concepts are just confusing. I mean, the government definitely prints money, and it definitely lends that money, which is why the government definitely prints money, and then it lends that money by selling bonds. Is that what they do? They sell bonds. Yeah, they sell bonds, right? Since they sell bonds and people buy the bonds and lend them the money. Yeah. So a lot of times, at least to my ear with MMT, the language and the concepts can be kind of unnecessarily confusing, but there is no question that the government prints money and then it uses that money to, I guess I can't really talk. I don't get it. I don't know what they're talking about.
Well, geez. How's that for clarity and confidence from today's major decision makers on our economy? Gosh. Now, in my opinion, back in 2020, our government, they set up the wrong incentive structure to deal with the pandemic. Remember things like the PPP, the Paycheck Protection Program. Remember mortgage loan forbearance and the eviction moratorium. See, when that type of aid is given, well, then the result is that citizens don't learn that they need to keep some cash handy, and then that behavior that gets rewarded gets repeated, and that behavior is handouts, and then the expectation for more handouts. 56% of Americans don't even have $1,000 for an emergency expense. Well, see, they're not really incentivized to in the future if in a crisis, everyone just gets another taxpayer-funded handout. But then see, those same people that got that handout get hurt in the long run anyway with the longer run inflation that the handout created. Don't let there be one day of austerity for the least prepared American, I guess. Instead, bail them out and add on to everyone's debt load, which, that right there, that seems to be the playbook. Like, that is the protocol of the day. That is not responsible in my view. Now, the minutes of the latest Fed meeting, they said that some Fed officials would be open to raising interest rates if inflation doesn't let up. I mean, that news alone, that sent stocks plunging like they were riding the Tower of Terror, giving the Dow its worst day in a while. I'll discuss that more with the father of Reaganomics, David Stockman, today. It's the kind of episode that can stretch your thinking here. Now, what is Reaganomics? Well, one thing that you should know is that it's committed to the doctrine of supply-side economics. You've probably heard that term before, and really what that's all about is lowering taxes, decreasing regulation, and allowing free trade. And what was called the Reagan budget, that's something that his budget director, Stockman, expected would help curtail the welfare state, and he gained a reputation as a tough negotiator for that. He lives on the Upper East Side of Manhattan today, and it's kind of funny. With macroeconomic discussions, you'll notice something here. The word million, that doesn't even come up that much anymore. It's simply a number that is too small. It is more like billion and trillion. And hey, let's see if the term 3 orders of magnitude above trillion comes up today. Quadrillion, or even the one after that, quintillion. Is that where we're going next? We'll see. Before we meet David Stockman, I've gotten more questions about something because the national average bank account pays less than 1% on your savings. And where do you really get a decent yield on your savings, even beyond the 5% in an online-only savings account or a CD, which that does not outpace true inflation? For years now, I've reliably been getting 8%. What I do is keep my dollars in a private liquidity fund. You can do this too. Your cash generates up to an 8% return. The minimum investment amount is just $25K, and you keep getting paid until you decide that you want your money back. And the private liquidity fund, it has a decade-plus track record, and they've always paid their investors 100% in full and on time. And I would know this because I am an investor with them myself. So see what it feels like to earn 8%. A lot of other GRE listeners are. Any investing involves risk, even dollars at a brick-and-mortar bank. So to learn more, just text the word family to 66866. Learn more about the liquidity fund. Get 8% interest. Just do it right now while you're thinking about it. Text family to 66866. Let's meet David Stockman. A Wall Street and Washington insider and Harvard grad, today's guest is a former 2-time congressman from Michigan, a prolific author, and he is none other than the man known as the father of Reaganomics. He was indeed President Ronald Reagan's budget advisor. Welcome to the show, David Stockman.
Great to be with you. And that was a while back, but I think there's some lessons from that time that we would be well advised to try to apply today. That's for sure.
Well, it's an illustrious title that you'll never shake. It's a pleasure to have you here. And David, as a real estate investing show, at times we need to step back and look at the bigger picture. And now on the economy, one seems to get a different answer depending on who they speak with. You have a highly qualified opinion. What do both investors and citizens need to know today about the condition of the American economy?
I don't think the outlook is very promising, but I think it's important to understand what that means for real estate investors. Because the fact is, if you're in real estate, and I know many of your listeners or viewers are very knowledgeable and sophisticated, there's really 2 ways to look at real estate. One is as a property that generates a flow of cash or income that is highly reliable and that you can count on and produces a rate of return on the invested capital that's attractive. That's one way. The second way is that if you invest at the right time, when perhaps interest rates are falling and therefore multiples or cap rates are becoming more attractive, and property values are rising rapidly, mainly because of easy money and lower interest rates, then there's a huge opportunity for capital gains as another way of generating return on capital. But those are 2 obviously very different tracks. The capital gains route, buy, hold, invest, improve, flip, collect the gain and move on, or the income-based, rent and earnings-based approach to property. Now, I think reason I went through this is pretty elementary, of course, is that the macro environment is very different between the first strategy and the second strategy. And therefore, the important thing to understand about the macro environment is which environment are you in, and is it conducive to strategy A, the income strategy, or B, the capital gain strategy? I would say right now, we're totally in an incomes strategy environment, the first round. And that's because we've gone through several decades of easy money, of rapidly rising asset values, of ultra-low interest rates, of very high multiples in terms of property values to income. That has generated trillions and trillions of capital gains for smart real estate investors. But I think we're out of that environment, and we're in an environment now where we're stuck with massive public debts and deficits. We're stuck with a central bank that is basically painted itself into a corner, created so much fiat credit, generated so much liquidity into the economy that now it will be struggling with inflation for years to come, which means notwithstanding Wall Street's constant belief that rate cuts are coming tomorrow, there won't be rate cuts for a long time to come. And what we're facing, therefore, is likely higher rates for longer, an environment in which property values are flat, if not declining. And therefore, the capital gains route is not going to work very well. But if you have good properties with good tenants and good cash flows and rental flows, real estate might work out pretty well. But you have to understand the macro environment. And that's one of the things that I work on daily when I publish my daily newsletter, which is called David Stockman's Contra Corner.
You're going to learn more about Contra Corner, David's blog, before we're done today. David, you have a lot of interesting things to say there. We are in this environment where rates have been higher longer. It sounds like you believe that is going to continue to be the case as rate cuts will be postponed. This is a little more difficult question. It's some crystal ball stuff, but can you tell us more about that? What can we expect for inflation and interest rates for the rest of this 2020s decade, which has about 6 years to go?
There's going to be high rates for most of this decade because we have so much inflation and excess demand built into the economy. We really went overboard, especially after 2020 with the pandemic lockdowns and then these massive stimulus programs. Something like $6 trillion of added stimulus was injected into the economy in less than 12 months.
Yeah.
That created an undertow of inflation that is still with us. And despite all the hopeful commentary that comes from Wall Street, if you look at it year to date, I don't look at just the CPI because the headline number is somewhat volatile and can be pushed and pulled a lot from month to month based on non-recurring conditions. But if you look at something called the 16% trimmed mean CPI. It's just the same CPI, but it takes out the lowest 8%, the highest 8% of price observations each month out of the thousands in the market basket. What it does is basically takes the extreme volatility out of the top and the bottom and gives you a trend that is more reliable if you're looking like on a quarter by quarter or year by year or even multi-year basis. Well, I mentioned this, it's important because the trim mean CPI is still running at about 4.3% during the first 4 months of this year to date. That's not a victory over inflation. That's double what the Fed says its target is. And frankly, the Fed's target is a little bit phony. I mean, what's so great about 2% inflation? If you're a saver and your savings are, shrinking by 30% over the course of a decade. So they're going to have a tremendous wrestling match with inflation, not just for a few more months, but I think for several more years in this decade. I don't see the federal funds rate, which is kind of the benchmark rate for overnight money, coming down below 5% very soon, or if at all. And that's because with inflation running at 4% or better, if you have a 5% money market rate, you're barely getting a return on capital, especially if you factor in taxes. It's like it's a rounding error. And that doesn't work over time. I mean, you're not going to get long-term savings. You're not going to get long-term capital investment if the returns after inflation and taxes are either non-existent or negative, as they've been for quite a while. So even though everybody would like to hope we're going back to the good old days of 0% overnight money or 1% money, which they got so used to over the last couple of decades. It was bad policy. It wasn't sustainable. It caused a huge amount of bubbles and distortions in our economy. But once we finally got to the end of that in March 2022, when the Fed had to finally pivot and say, yeah, inflation isn't transitory, it's embedded, we got to do something about it, people think we're going right back to where we were. And that's the key thing to understand. We are not going right back to where we were, in part because of all this inflation business I've talked about, but also in part because they got so used to borrowing money on Capitol Hill at practically zero interest rates that they are now, they've built in deficits of $2 trillion or more a year. And we're going to be pushing into the bond pits massive amounts of new government debt. There's no consensus to do anything about it. If the Republicans talk about reforming the entitlements, the Democrats say you're throwing grandma out in the snow. If the Democrats talk about raising revenue, the Republicans talk about you're going to get slaughtered with higher taxes. And then everybody's for more wars and more defense and a bigger and bigger national security budget. And that's all she wrote. If you don't do with revenue, you don't do with national defense and entitlements, the rest of it is rounding errors. And so we're stuck with these massive additions to the debt. Now, everybody knows the public debt is $34 trillion already. Yeah. What I think they don't understand is that by the end of this decade, you ask about the decade, we'll be close to $60 trillion of public debt. And if you look at the last CBO projection, they do every year a long-term projection. And CBO actually is more optimistic than it is warranted in any way. In other words, their long-term assumptions I call rosy scenario. There's no more recessions for the next couple decades. Inflation is well behaved. Interest rates stay low. Full employment lasts indefinitely and forever. Well, this doesn't happen. Look at the real world over the last 20, 30 years. We've been all over the lot. So if you look at the CBO forecast, which, as I'm just saying here, is exceedingly optimistic, they nevertheless are projecting that the public debt, and they don't even write this number down in their report because it's too scary, will be $100 trillion before the middle of this century.
That's unfathomable.
$100 trillion.
Yeah.
Now, if you ask people today who are market savvy, like a lot of your viewers, where are the Treasury bills, notes, and bonds today? Well, if you average it all out, it's about 5%. I don't think it's going to come down much. It'll vary a little bit up and down over time. But let's just say it stays at 5%. That means the carry cost of the public debt out a couple decades will be $5 trillion a year. The interest, okay, it's staggering. That's almost as much as the whole federal budget spending is today at, about 6.6, 6.7 trillion. So that's where we're heading, a massive debt crisis because they built in a structural deficit that the politicians and I call it the uniparty, they fight about silly things, but they agree on the big things which are leading to this outcome. The uniparty has no ability to do anything about this structural deficit or the march from the $34 trillion that we're at today to $60 trillion by the end of the decade and $100 trillion of public debt by mid-century. Now, for a real estate investor, that's probably the most important number you're going to hear, at least this week or maybe this month or even this year. Because what it means is that the amount of new government debt flowing into the bond pits that'll have to be financed, and that can't be monetized by the Fed anymore because there's too much inflation, is going to put constant, enormous pressure upward on interest rates. And of course, higher interest rates mean lower property values. That's just basic real estate math. That's the environment we're heading into, which means good properties with good income and good rental flows are really the only way to go.
Yeah, well, there's an awful lot there. And with this persistent higher inflation that you expect, the way I think about it is the higher the rate of inflation, the more that moves a person's dollars out of a savings account and instead out onto the risk curve. Well, David alluded to a problematic economy. We're going to come back and talk about more of those warning signs and what you can do about it. You're listening to Get Rich Education, the father of Reaganomics and Ronald Reagan's budget director, David Stockman. I'm your host, Keith Reinhold. For a lender that's a specific expert with income property, you need Ridge Lending Group and MLS 42056. In GRE history, from beginners to veterans, they provided our listeners with more mortgages than anyone. It's where I get my own loans for single-family rentals up to fourplexes. Start your pre-qualification and chat with President Chaley Ridge personally. They'll even customize a plan tailored to you for growing your portfolio. Start at ridgelendinggroup.com. ridgelendinggroup.com.
This is author Jim Rickards. Listen to Get Rich Education with Keith Reinhold and don't quit your day dream.
Welcome back to Get Rich Education. We're talking with the father of Reaganomics. His name is David Stockman, President Reagan's budget advisor. David, you've been talking about a problematic economy and places we can look and the outcomes that can create. Why don't we talk about some more of those, where we're here in a period where we feel like it's an official recession postponed? For example, are there other places we should be looking? Is it the sustained inverted yield curve that we had for almost 2 years, the longest one ever and a great recession predictor? Or is it that we're on the precipice of implosion from a debt to GDP ratio that's at 122%? It actually spiked to 133% when COVID first hit. Or for example, is it something, and you've already touched on it a bit, is it more with that federal spending on our debt's interest payments alone each year, which at almost $900 billion for that interest line item, that now even exceeds the massive $800 billion that we spend each year on national defense? Or should we be looking at somewhere else? So what's out there that's really problematic and what's overblown?
Okay, that's great. And all of those things you mentioned, you should be looking at. It depends on your time frame. But I think on the initial question, where is this postponed recession? Why hasn't it happened? The place to look is somewhere that I think most Wall Street analysts aren't focused on, but they should be. And that's a series published by the Federal Reserve that tracks household balance sheets. In other words, liabilities and assets. But there's a particular series that I think is critically important to look at. And it's basically bank deposits, checking accounts, savings accounts, plus money market funds. This is all the liquid cash accounts of the household sector, not long-term investments in real estate or stock or bonds, but the short-term money. It's the spendable money that households have. Now, what happened during the pandemic, lockdowns, and then the $6 trillion of stimmies that were injected into the economy, like some kind of fiscal madness was going on in Washington, created a total aberration in the amount of cash in the economy, in the household sector, in these accounts that I've just mentioned. Normally, right before the lockdown started and the stimulus was injected, the level of cash accounts was about 12 trillion. Within 2 years, it was up to 18 trillion. And normally that cash balance grows about the same rate as the economy. In other words, as incomes go up, people save a small share of their income. It goes into various bank accounts. There tends to be a lockstep relationship. But what happened during that 2-year period was there was so much extra cash sent out to the households with the $2,000 checks and the $600 a week extra stimulus money, and then the trillions that went, for things like the Small Business Administration loan program, which was all forgivable. It was about almost upwards of $1 trillion. And, we could itemize all the others. But this enormous government unusual cash flow into the economy added to these bank accounts enormously, and then something else happened. The geniuses in Washington, led by Dr. Fauci, decided to shut down half of the service sector of the economy. I'm talking about restaurants and bars and gyms, and malls and movies and all the rest of it. So all of a sudden, the normal money that people would have been spending on the service venues, which is a big part of total spending, was stopped. It was kind of forced into artificial savings, sort of government-mandated savings. Now, if you put the two together, there was about $2 trillion of extra transfer payments sent out to the public during that 2-year period. And there was a little over $1 trillion of normal service spending, restaurants and et cetera, that didn't happen because there was a closed sign on the door, compliments of Dr. Fauci. Or people were scared to death to go out because, they created all this fear that COVID was some form of Black Death, which it really wasn't for 95% of the population. In any event, if you put the extra free stuff from the government, $2 trillion, and the forced savings because of these lockdowns, $1 trillion, you have $3 trillion of unusual cash that flowed into the economy on top of the normal production and income and profits and spending that would have otherwise gone on. Now, that $3 trillion temporarily ended up in this account that I'm just talking about, the cash balances of the household sector. At its peak, there was about $2.8 trillion extra compared to what would be the normal case in a regular economy, in a normal economy. That money has been slowly spent down by the household sector, even as the Fed has tried to put the screws to the economy. In other words, there was so much extra cash in the system that even as the Fed raised interest rates from 0 to 5% and did their darndest to slow things down, all of that excess that was built up during the pandemic period was available to spend. It was spent. And here's the key point, about half of it has now been spent. In other words, there's only about $1.5 trillion of the near $3 trillion left. Now, that is what's delayed the recession. If that big, massive $3 trillion nest egg hadn't been there, and the Fed began to push rates up as it normally did in a normal cycle, we would have been in recession months ago. But what has delayed or deferred the recession is this cushion, this huge macro piggy bank of cash that the government inadvertently or advertently, as the case may be, generated during the pandemic period. So that's new. See, that nobody looks at that because normally it's not a factor. The cash balances are a pretty prosaic, neutral part of the economy. They're not where you look for the leading edge of where the cycle is going or where new developments may turn up tomorrow. But this time, because of this total aberration of what happened to government transfer payments plus the lockdowns, we have a X factor, let's call it, in the macro picture that is confusing people. It's leading a lot of people to advocate this no landing scenario. In other words, there's not going to be a recession. We're just going to go on to bigger and better things. And the Fed will get inflation under control, and then we can be back to happy times again. No, they're missing. The elephant in the room is this massive, aberrational, unusual one-time cash balance that was generated by these policies, and that still has a little ways to go. Now, I think at the rate it's being run down, you can almost calculate it, $200 billion a quarter. Sometime next year, all of that extra cash will be out of the system, and then people will be back to spending only what they're earning. And frankly, earnings are not, I'm talking about wage and salary earnings, are advancing barely at the inflation rate at the present time. So when we get back to about zero real growth in earnings, we're going to finally see the recession.
I think one of the big takeaways here is that all these artificial economic injections really take time to unwind.
Exactly. You have to look at, they always say, well, when the government changes policy, fiscal policy, you tighten or you loosen, or monetary policy, they raise or lower interest rates. They got QE or they got QT, putting money in or taking money out, that there's lag and lead times in all of this. The problem is none of the great economic gurus who talk about this really know whether the lag time is 12 months, 25 months,
Right.
50, or 5. And it varies. I mean, the circumstances change so much in a world GDP of 104 trillion, a domestic economy with 28 trillion of GDP, and all the complex factors that are moving back and forth in today's world, especially as it's enabled by technology and global trade and the internet and all the rest of it. Nobody knows the lag times. And as a result, it's very hard to predict when the brown stuff is going to hit the fan, so to speak. On the other hand, you don't have to know the exact date. You really need to understand the direction, the flow of things. And if you're in an environment that isn't sustainable because you're borrowing like crazy, or interest rates are artificially low, or stock price multiples are way the hell too high, or cap rates on real estate are, aberrantly low, then what you have to say is we're going to a different state. It's not going to be as conducive as the current state, and we have to be prepared for it, even if we are not sure whether that's 12 months from now or 24 months. But it's going to change. But one thing you can be sure of, there was a famous economist back in my day when I worked on Capitol Hill earlier on. He was Nixon's chief economic advisor in the early 70s, and he famously formulated an aphorism, I guess, which said, anything that is unsustainable tends to stop. Okay, that's what I know about the lag times. We're in an unsustainable financial, fiscal, and monetary environment, and the trends that it has given rise to are going to stop, and not in a good way.
Even Fed Chair Jerome Powell has confessed as much as that this situation is indeed unsustainable, the exact word that he used. Well, David, this has been great. In winding down, as Ronald Reagan's budget director, can you share any anecdote, story, or quote from you spending time personally with Ronald Reagan? And the reason I ask is because he is perhaps the most revered president of the past few generations. That might mean a lot to our listeners here.
He should be revered, and not only because he was a great president and a great communicator and did a lot of important things in policy. Some of them got implemented, and a lot of them were frustrated by Washington and the politicians and the Democrats and everybody else. But also, he was a great human being. And my story about that was when I was budget director in the 5th year of the Reagan administration, we had our first child, and my wife was in the hospital. At that point in time, President Reagan was in Europe on a very important, big international series of meetings. But somebody in the White House told him that our daughter had been born. And so he took the time out in his schedule for a call from Germany, the hospital where my wife was, and said he would like to talk to her and congratulate us on our new arrival. But my wife was in a room with another her new mother. The other person answered the phone, and she said to my wife, "There's some joker on the phone who says he's President Reagan." And sure enough, he was there, and he took the time to congratulate my wife and us. So that's the kind of person he was. He really was a great human being.
Wow. Yeah, that really shows that he can still be warm and heartfelt even while doing some key international negotiations there, potentially. Well, we mentioned it earlier. I can tell you, the audience, that David is a regular author and contributor to his Contra Corner blog and letter, and you can get access to that for free. This is information coming from the father of Reaganomics to you if you think you would find it of value. David, tell us how our audience can connect with you there.
Just Google David Stockman's Contra Corner. I have a website. It issues a newsletter every day. It comes automatically in the email. I also have a Substack version. You could sign up for either one, the email from my site or from Substack. And every day we try to publish something on these issues that we've been talking about. One day it might be Wall Street, another day it might be Capitol Hill, another day it might be, the war in Ukraine. All of these things matter. All of these things influence the environment that investors have to function in. So we try to comment on a variety of those issues based on, the long experience that I've had, both not only in Washington, but also I was on Wall Street for about 20 years. I was one of the founding partners of Blackstone, for instance, and we were in the real estate business in a major way even then.
Well, we absolutely love that, and I sure am appreciative of your time. It was great connecting with you, and thanks for being on the program today, David.
Very good. Enjoyed it.
Yeah, deep insights from the father of Reaganomics. Stockman thinks we'll be struggling with inflation for years to come. There won't be rate cuts for a long time. He sees real estate values as flat or declining, so have good tenants with steady income streams. Of course, in our favored real estate segment here, residential 1 to 4 units where you can get 30-year fixed rate debt, higher mortgage rates tend to correlate with higher prices, just like it has for the last 3 years and almost every period before that too. But there could be more pain for the commercial sector then and assets that are tied to floating rate debt. And if you're aligned with David Stockman on that, you might want to look at your HELOCs, because after a fixed rate period, their rates tend to float along with the Fed funds rate. So be cautious with HELOCs. And I asked David for specifics. He doesn't see the federal funds rate coming down below 5% anytime soon. And you probably know that is the interest rate that a whole bunch of other interest rates are based off of. And that rate is currently at about 5.3%, by the way. There is projected to be more than $100 trillion of public debt before the middle of this century. That's less than 25 years away. I mean, these figures just become unfathomable sometimes. Pandemic-wrought inflation that really occurred due to this greater supply of dollars that was introduced, chasing a reduced supply of goods, and there were fewer goods because people got paid to stay at home, not producing anything, plus what had been produced often could not be shipped either. David discussed the 16% trimmed mean CPI, and I've got to say, as much as I am a student devotee in studying inflation, I had never heard of that. From his vantage point, to find recession signs, look at household balance sheets, and what's delayed the recession is that those pandemic measures put an extra $3 trillion into households, and households still have about $1.5 trillion left to spend, which could further delay a recession. He projects that it's sometime next year that all of that extra cash will be out of the system. When you talk to how many people got this recession prediction so horribly wrong, back in October 2022, Bloomberg Economics forecast a 100% chance of a recession by the following fall, which is almost a year ago now. Well, a 100% chance, that left no room for anything else to happen, and they really whiffed on that one. Now, I've got to add something here, a personal note if I can, but I'll give you a lesson along with it, and that is that at times like today, where I found myself 1 degree of separation from one of the most revered presidents in all of American history, I sometimes have some difficulty understanding how I keep having the opportunity to share time with people like today's guest. Now, I'm certainly not a PhD economist, and in fact, on the flip side, I've also never been a person that's been so poor and destitute that I was dying of hunger, but I do come from a modest place. when I flew the coop and left my parents' home, I rented my first pathetic place to live, a $325 a month pool house in the back of my landlord's property at 852 Spruce Avenue in Westchester, Pennsylvania. Yeah, a pathetic little pool house right next to the landlord's swimming pool. I mean, I was living really pathetically there for a while as I was struggling just to do things like find gainful employment and figure out the world and find a steady income. Yeah, it was $325 a month plus electric, and the one small heater that was there, it was electric and it was really expensive to run. And on the coldest days, it wouldn't even adequately heat my pathetic little pool house that I ended up living in for 18 months, just because I couldn't figure a way out of that situation for a while. I mean, I was too ashamed to ever bring a girl back there to that sad pool house. There was just one sink for the whole place, combined kitchen and bathroom sink in the bathroom. I mean, most of my friends, they got their driver's license at age 16, and they soon had their own car. I didn't own a car until I was age 22 or 23, and it's not because I lived in an urban area and walked everywhere or used public transit there in Pennsylvania. It just took me a long time to afford a beater car and pay for insurance. I really needed a car and couldn't afford one. So really my point here is that sometimes I have to wonder how I got here from there. And I think what it is taking an interest in real estate and investing, and despite just having a humble bachelor's degree in geography, it's really about becoming an autodidact, meaning self-taught. And it's easy to teach yourself when you find what interests you. And let me point to two other things besides adopting an autodidactic ethic to help me turn the corner into being in a place where I can have conversations like the one that I've had today. It was getting around aspirational friends, like I've mentioned before, that showed me how I can start with a bang with little money. On my first home, I could put a 3.5% down payment on a fourplex, live in one unit and rent out the other three, and I will give myself some credit for doing those things. And then really the third thing is that stroke of luck element. Like just 4% of world inhabitants have been. I was one of that 4% that was born in the United States. And then I had two great, married, stable, supportive parents to cultivate the right environment for me. And, well, today was just one of those days where I sort of nudged myself, and I'm glad that it happened. Most importantly, I trust that you got value from today's show and that you do every single week here. Check out David Stockman's Contra Corner. Next week, we'll look for signs of distress in real estate as we delve inside the foreclosure market and how you can find discounted deals there. Until then, I'm your host, Keith Reinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.